Hello and welcome. We're excited today to discuss a popular topic, which is mega backdoor Roth solo 401k contributions. Thank you so much for joining. Let's get started. We want to go over some slides. We want to go deep on this topic of mega backdoor Roth solo 401k contributions. It's specifically geared towards businesses that are taxed as a partnership, businesses that are filing a 1065, such as a multi-member LLC. So, of course, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professionals. We have a wealth of resources we want to take time to highlight. We go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern, and then now we're back again here in our afternoon session at 1 p.m. Pacific, 4 p.m. Eastern. You can always subscribe to our YouTube channel. Of course, if you find this video to be helpful, please like, as it helps us to get the word out. If you subscribe and hit the notifications bell, then you'll get the notifications of when we go live. You can jump on and ask questions or hear what others might be asking. So another great resource is our community. We have over 30,000 members. It's a vibrant community. Individuals are posting 24/7 in the forums. So that's another great venue to ask questions or hear what other folks are asking, just to learn, to share the knowledge. We'd like to go deep on Friday. Today's topic, again, is mega backdoor Roth solo 401k contributions. We want to give a deep dive review, A to Z, of how one makes mega backdoor Roth solo 401k contributions, specifically for businesses that are taxed as a partnership or file a Form 1065. Previously, if you look at our YouTube channel, you can see the history. We've had similar sessions focused on businesses taxed as a sole prop, businesses taxed as an S corp. On the docket, we usually bring some content every single day to these live Q&As. Of course, we are happy to field questions. We love to take questions and to discuss these topics. Typically, if someone has a question, someone else probably has the same question. So it can be really helpful. But on the docket for more deep dive content is going to be how much income to maximize contributions, that magic number, in other words, of income that you would need to be able to maximize, whether you're trying to maximize pre-tax or Roth. So if you subscribe to the channel, you'll get notifications and be able to join live or at least watch the recording later. As far as the agenda for today, we're going to go over the contribution limits and then apply those limits to different scenarios and examples. We're going to talk about A to Z, so all the mechanics, right? How to use our online calculator, what's the deadline, how to make contributions, how to report contributions, how to convert, right? Because when you make a mega backdoor Roth solo 401k contribution, it's really a two-step process. The first step is to deposit the voluntary after-tax contribution. And then the second step is to convert the money from the after-tax solo 401k account to a Roth account, either a Roth solo 401k or a Roth IRA. So we want to paint the picture as far as how that works and go over those mechanics. And then finally, we'll wrap up with some bonus content regarding the $1,500 solo 401k tax credit. And of course, if there are questions, please don't hesitate to ask, whether about these topics or even really any topics related to the solo 401k. So the benefits of the mega backdoor Roth solo 401k contribution is really to be able to maximize the funds that'll end up in your Roth account. Once the money's in the Roth account, that's where you've got that potential for tax-free growth. So with a mega backdoor Roth solo 401k contribution, individuals can contribute up to $69,000 or even $76,000 if they're age 50 or older for 2024, $70,000 for 2025, or if they're age 50 or older, they'll be able to contribute up to $77,500 or even $81,250 if they're age 60 to 63 because of the new super catch-up contribution limits. Now, finding a mega backdoor Roth solo 401k provider is going to entail, first of all, you have to be eligible. So you got to qualify. You got to be self-employed with no full-time W-2 employees. Then you need to find a provider that offers a plan that allows for voluntary after-tax contributions and then in-service distributions. Because that's where it's that two-step process. First, being able to make the after-tax contribution, and then second step, move the after-tax funds over to a Roth solo 401k or Roth IRA. You also want to work, of course, with a provider that's going to be able to assist with all those mechanics, right? Because it is a specific process that you have to go through. There needs to be separate accounts, for example, a separate after-tax account versus a separate Roth account. And then there's going to be required reporting. So even though that first step, when you make the contribution, that's not reportable, the second step, when you move the funds from the after-tax account to the Roth account, that is reportable on a Form 1099-R. Now, we handle that as an optional free service for our customers. In other words, no additional charge. Customers just have to let us know about that after-tax to Roth transfer so we can capture the information we need to prepare the 1099-R. So whenever we talk about, making contributions, it's always good to recognize that there are certain basic factors. In other words, how much one can contribute to the solo 401k will depend on different factors. One factor is your income, specifically your self-employment income, because the purpose of the solo 401k is for someone to earn self-employment income in a 401k account. You can't save more than you earn. So that's going to be one factor that'll dictate how much one can contribute to the solo 401k. Another factor is age, right? As we saw in the earlier slides, the overall limit, how much you can contribute, goes up once you're age 50 or older. And then now with the super catch-up contribution limits for 2025, if you're age 60 to 63, there's even a higher level that the individual could potentially contribute up to. An additional factor is whether you participate and make contributions to another plan, like a day job 401k plan. And then, of course, contributions, right? So some individuals, they first want to maximize the pre-tax contributions before making Roth or voluntary after-tax contributions, whereas other individuals just want to maximize the mega backdoor Roth. So the type of contribution will also dictate how much you can contribute, because there's different sublimits, as we'll see as we go through the explanation. Now, starting to dig deep into those different factors, remember, one factor is you can't save more than you earn. So it's going to depend on your self-employment income. For a business tax as a partnership, self-employment income is equal to your net income reported on line 14 of your K-1, less 1/2 of the self-employment tax. So you have to run that pre-calculation. And we help our customers do it. We have a calculator on our website that will help determine 1/2 of self-employment tax. Now, of course, you cannot consider W-2 wages from other sources like a day job. You also can't consider investment income. It's got to be based on that earned self-employment income. So this is a great slide as it illustrates how you have to run that pre-calculation. Take line 14, code A on schedule 1. This is your net self-employment income. Then reduce that amount by 1/2 of the self-employment tax. And that is considered self-employment compensation. That's the amount upon which you determine how much one can contribute to the solo 401k. Now, as I mentioned, there's different limits, right? First, you have the overall limit. And a solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because the individual can contribute and fill up different buckets, right? You've got the employee bucket versus the employer bucket. So first, you got to consider the overall limit. Then you got the sub limits for each type of contribution. And we'll look at each of those different limits. So for 2024, the overall limit is $69,000 plus an additional $7,500 if you're 50 or older. For 2025, the overall limit goes up to $70,000. The catch-up contribution limit of $7,500 stays the same for those age 50 or older. But now we have an additional super catch-up contribution limit. So instead of $7,500, if you're age 60 to 63, it's going to be $11,250. So that's where you could potentially contribute up to $81,250. So as I mentioned, there's different buckets that one can fill up within the solo 401k. In the words of the IRS, you're both the employee and the employer. So you've got employee contributions as well as employer contributions. And then for those who have a plan like ours, which allows for not only pre-tax contributions that reduces the taxable income for the year for which the contribution is being made, our plan also allows for Roth contributions, both employee and employer, as well as voluntary after-tax contributions. Voluntary after-tax contributions are how one makes mega backdoor Roth contributions. So in terms of the different sublimits, if you look at first the employee, it's also referred to as salary deferrals. So the limit that applies to a business tax as a partnership is, again, based on the self-employment compensation. You got to start out by determining self-employment compensation, which is line 14 of your K-1, less 1/2 of the self-employment tax. Then of that amount, the individual can contribute 100% of their self-employment compensation, up to $23,000 for 2024, plus an additional $7,500 if they're age 50 or older. Now, for 2025, that limit increases to $23,500 or $31,000 if they're age 50 or older, or $34,750 because of the super catch-up for those age 60 to 63. It's important to recognize that the employee contribution limit applies at the employee level, so across all plans that the individual contributes to. So if they're making contributions to another plan through an unrelated employer, like a day job plan, they need to aggregate all those contributions. So if they already max out to their day job plan, they're not going to be able to make any more employee contributions to the solo 401k. Now, the exception to that rule that you have to aggregate across all plans that the employee contributes to is the 457 governmental plan exception. So you don't need to aggregate 457 contributions to a 457 governmental plan for purposes of determining how much the individual can contribute to a solo 401k. Now, our plan not only allows for the employee contributions to be made as pre-tax contributions that will reduce the taxable income for the year for which the contribution is made, but also allows for those employee contributions to be made as Roth contributions. In that case, the contributions are being made on an after-tax basis, but you have that potential for tax-free growth. If the individual is going to be making both pre-tax and Roth contributions, those contributions need to be deposited into separate sub-accounts for each participant. The next contribution type is employer contributions. It's also referred to as profit-sharing contributions. For a business, tax is a partnership. Multi-member LLC tax is a partnership where the income is reported on the 1065. The limit is equal to 20% of the self-employment compensation. Again, line 14 of the K-1, less 1/2 of the self-employment tax, then multiplied times 20%. That's the employer contribution limit. Now, keep in mind that the total or the sum of contributions made to the solo 401k, whether employee, employer, and or voluntary after tax, could not exceed the lesser of the self-employment compensation or the overall limit. Remember, the overall limit for 2024 is $69,000 or $76,500 if you're age 50 or older. For 2025, it goes up to $70,000 or $77,500 if you're age 50 or older, or even $81,250 if you're age 60 to 63. So contrast employer contributions where it applies at the employee level across all the plans that the individual contributes to. For employer contributions, it applies at the plan level. In other words, your ability to make employer contributions to a solo 401k is not impacted by contributions made to another plan through an unrelated employer, such as a day job 401k plan. Now, the one exception to that rule that you don't need to aggregate for purposes of determining how much you can contribute as an employer contribution to the solo 401k is the 403B exception. So all the contributions made to the 403B, whether employee, employer, together with any contributions that the individual wants to make to the solo 401k, whether employee, employer, and or voluntary after tax, the sum of those amounts cannot exceed the overall limit. Now, with Secure Act 2.0, it now allows for employer contributions to be made as Roth contributions. Historically, those employer contributions were always made as pre-tax contributions, as tax-deductible contributions. Now, while our plan does allow for employer contributions to be made as Roth contributions, based on experience and client feedback, most customers who want to maximize the amount of funds going into their Roth account would choose not to make employer contributions as Roth contributions, but instead simply to make those contributions as voluntary after-tax contributions. So they would skip making employer contributions. Why is that? Well, number one, the voluntary after-tax contribution limit, unlike the employer contribution limit, which is a percentage of your self-employment compensation, the voluntary after-tax contribution limit is 100% of self-employment compensation up to the applicable limit. So that means you don't need as much self-employment income to be able to maximize the contributions. From a deadline perspective, the deadline to make both voluntary after-tax contributions and employer contributions is the same. It's the business tax return deadline, including any timely filed extension. Lastly, there's more flexibility with respect to voluntary after-tax contributions. So for example, one can make voluntary after-tax contributions and transfer those funds out of the solo 401k to a Roth IRA. Whereas if one wanted to transfer employer contributions that were made as Roth contributions and then move those out of the solo 401k to a Roth IRA, they'd have to meet a triggering event. And an example of a triggering event is attaining age 59 and a half or older. So given those factors, again, most of our customers, based on experience and client feedback, if they want to maximize the funds going into a Roth solo 401k, they would just simply decline to make employer contributions as Roth contributions and instead just make voluntary after-tax contributions. But if one is going to make employer contributions as Roth contributions, here are some frequently asked questions. Number one, do I need to deposit those employer contributions made as Roth contributions into a separate account? The answer is no. Both employee and employer contributions made as Roth contributions may be deposited into the same bank or brokerage account for Roth solo 401k funds. Number two, what is the contribution limit for employer solo 401k contributions made as Roth contributions? Well, it's the same. Whether you're making pre-tax or Roth employer contributions, the limit is the same. It's 20% of self-employment compensation. Finally, how do I report employer solo 401k contributions made as Roth contributions on my personal or business tax return? Well, this was an open question. As I mentioned, historically, employer contributions were always made as pre-tax contributions. So there was a big question as far as, okay, well, how do I report these employer contributions if they're made as Roth contributions? And the question wasn't answered for almost a year until after the Secure Act 2.0 was enacted by the IRS via IRS Notice 2024-2, where they clarified that employer contributions made as Roth contributions are reported as tax deductible on the employer's return for the year for which the contributions are made. For example, the Form 1065, and then reported as taxable to the employee for the year for which the contributions are deposited. So we got a quick just tweak here to the slides. So it's going to be reported as tax deductible on the employer's return. So that's the Form 1065 for a business tax as a partnership, but then again reported as taxable to the employee for the year of the deposit via Form 1099-R. So now let's turn to the limits that apply to voluntary after-tax contributions. Remember, this is how one makes mega backdoor Roth contributions. So the limit is the lesser of self-employment compensation or the overall limit. Remember, the overall limit for 2024 is $69,000, $70,000 for 2025. Another way to say that is that one can contribute 100% of their self-employment compensation dollar for dollar up to the overall limit as a voluntary after-tax contribution. Now, it's noteworthy, of course, that you still have to recognize that overall limit. So the sum of any other contributions being made to the solo 401k, whether employee or employer, together with the voluntary after-tax contributions that one wants to make, the sum of those amounts cannot exceed the lesser of self-employment compensation or the overall limit. Now, it's noteworthy that the catch-up contribution is not made as a voluntary after-tax contribution. Instead, it needs to be made as an elective deferral, an employee contribution, either directly to the pre-tax account or directly to the Roth account. But for purposes of aggregating and considering how much one can contribute as a voluntary after-tax contribution, you can ignore the catch-up contribution. So you don't have to reduce how much you can contribute as a voluntary after-tax contribution by catch-up contributions made. So ultimately, one would still be able to contribute up to those higher amounts, for example, $77,500 for 2025 if you're age 50 or older. But just note that those catch-up contributions wouldn't be made as voluntary after-tax contributions. They'd have to be made as employee contributions directly to the pre-tax or the Roth account. Now, even though a voluntary after-tax contribution is a type of employee contribution, it's not like the other type of employee contributions, the pre-tax and Roth, the salary deferrals, in that one does not need to reduce how much one can contribute as a voluntary after-tax contribution by contributions made to another plan through an unrelated employer, like the day job 401k plan. So even though one might max out employee contributions to their day job 401k plan, that's not going to reduce how much they can contribute to the solo 401k as a voluntary after-tax contribution. Now, the one exception to that general rule is the 403b exception. Remember, under that 403b exception, all the contributions made to the 403b, whether employee or employer, together with the contributions that the individual wants to make to the solo 401k, whether employee, employer, or voluntary after tax, the sum of those amounts cannot exceed the overall limit. And then lastly, like employee contributions, where if you have both pre-tax and Roth contributions, those pre-tax and Roth contributions have to be deposited into separate sub-accounts. Likewise, voluntary after-tax contributions need to be deposited into separate sub-accounts. This is how one ends up with, say, 3 different accounts, pre-tax, Roth, and after-tax, or even 6 accounts if there's 2 participants, right? Say husband and wife, both working in the business. They each have pre-tax, Roth, and after-tax accounts for a total of 6 accounts. So now let's apply these rules to different contribution scenarios. So what we'll do is we'll start out with the baseline scenario, and then we'll tweak different factors to illustrate different points. So our baseline scenario provides that we have a self-employed business, taxed as a partnership, could be a multi-member LLC, taxed as a partnership that files a Form 1065. There's one participant who's under 50 years of age, does not make contributions to another plan like a day job plan. Their goal is to maximize pre-tax contributions and then make any additional contributions as Roth and or voluntary after-tax contributions. Let's assume they have $100,000 of self-employment compensation. In other words, line 14 of their K-1, less 1/2 of the self-employment tax, is equal to $100,000. Finally, we're also going to assume that any employer contributions are made as pre-tax contributions for the reasons discussed above. So based on this scenario, this individual will be able to contribute $23,000 as a pre-tax employee contribution for 2024, 20% of their self-employment compensation or $20,000 as a pre-tax employer contribution, and then do the difference up to $69,000 as a voluntary after-tax contribution. So for 2024, they end up with $43,000 in their pre-tax solo 401k account. They deposit $26,000 to their voluntary after-tax account, and then move those funds over to the Roth account, right? That's the mega backdoor Roth solo 401k contribution, where you first deposit to the after-tax, then move to the Roth. So between all the different contribution types, they're ending up being able to contribute $69,000. Now for 2025, they can contribute 100% of their self-employment compensation up to $23,500 as a pre-tax employee contribution. The employer contribution amount stays the same because it's still 20% of self-employment compensation. And now they can do the difference up to $70,000 as a voluntary after-tax contribution. So that's another $26,500. And then as part of that mega backdoor Roth solo 401k contribution strategy, they move the funds from the voluntary after-tax account over to the Roth account. Now let's tweak the scenario. Let's assume we got $50,000 of self-employment compensation instead of $100,000. So the employee contribution amounts will stay the same. The employer contribution amounts will go down because now it's 20% of $50,000. Likewise, the voluntary after-tax contribution amounts will go down because remember, the total amount of contributions to the solo 401k cannot exceed the lesser of self-employment compensation. Here, that's $50,000 or the overall limit. So that leaves another $17,000 for 2024, $16,500 for 2025. And again, as part of that mega backdoor Roth solo 401k contribution strategy, they'll move the funds from the voluntary after-tax account over to the Roth account. Now let's go back to the base, back to $100,000 of self-employment compensation, but let's assume now that the individual maxes out contributions to their day job plan. How does that impact how much they can contribute to the solo 401k? Well, because that employee limit applies at the employee level, and they've already maxed out these contributions to their day job plan, they're not going to be able to make any more contributions to the solo 401k as employee contributions. However, the employer limit, as well as the voluntary after-tax limit, is not reduced by those employee contributions made to the day job plan. So the employer contribution limit will stay the same, 20% of self-employment compensation or $20,000. The voluntary after-tax limit will go up. So now they can contribute the difference up to $69,000 for 2024 as a voluntary after-tax contribution, so another $49,000, another $50,000 for 2025. And then again, as part of that mega backdoor Roth solo 401k contribution strategy, they'll move those voluntary after-tax funds from the after-tax account over to the Roth account. So now let's go back to the base, back to not making contributions to another plan. But here what we're changing is the goal. So instead of being a first maximizing pre-tax and then making Roth or voluntary after-tax contributions, let's assume the individual is not interested in making pre-tax contributions and only interested in making Roth and mega backdoor Roth contributions. So that means that employee contribution amount will stay the same, but instead of depositing those funds into their pre-tax solo 401k, they'll deposit those funds into their Roth solo 401k. They're not interested in making employer contributions as pre-tax contributions, so they'll just skip making those employer contributions, and instead they'll make the difference up to the overall limit as a voluntary after-tax contribution. So another $46,000 for 2025, another $46,500, $46,000 for 2024, $46,500 for 2025. So at the end of the day, as part of that mega backdoor Roth solo 401k contribution strategy, they'll then move those voluntary after-tax funds over to their Roth solo 401k. They'll end up with $69,000 in their Roth solo 401k for 2024, $70,000 in their Roth solo 401k for 2025. So now let's go back to the base, back to first maximizing pre-tax contributions and then making any additional contributions as Roth and or voluntary after-tax contributions. Here we're going to tweak the number of participants. Now let's assume there's two spouses, both working in the business, both participating in the solo 401k. How does it impact how much each can contribute to the solo 401k? Well, the amounts don't change, right? Because we're assuming that each spouse is in the same scenario, right? Each spouse has $100,000 of self-employment compensation, et cetera, et cetera. So the amounts don't change. So what this scenario illustrates is that the ability for each spouse to contribute to the solo 401k is based on their scenario, their age, their contribution goals, their self-employment compensation. And since we're presuming that each spouse shares the same goals and scenario, that means that each spouse will be able to contribute the same amount to their respective solo 401k accounts. So now let's go back to the base. Now we're back to just having one participant, but let's presume that the individual is 50 or older. How does that impact how much they can contribute to the solo 401k? Well, it's not going to impact employer or voluntary after-tax contributions. What it impacts is the employee contribution, because now they can make that catch-up contribution. $7,500 if they're age 50 or older for both 2024 and 2025. And then if they're age 60 to 63, they can, instead of $7,500, they can make a catch-up contribution, a super catch-up contribution of $11,250. So that'll end up in their pre-tax employee bucket. Now, it's also noteworthy that the voluntary after-tax contribution limit is not changing. So even though one has to reduce how much they can contribute as a voluntary after-tax contributions by employee and employer contributions made to the solo 401k, one can ignore the super catch-up contributions and the catch-up contributions. So they'll still be able to end at the end of the day, contribute that same voluntary after-tax contribution amount. So now let's go back to the base. One person who's under age 50, they've maxed out contributions to their day job plan, but they're not interested in making pre-tax contributions to the solo 401k, only Roth or voluntary after-tax. So they're not going to be able to make employee contributions because they already maxed out to their day job plan. They're not interested in making employer pre-tax contributions. So they'll just simply contribute the full amount as a voluntary after-tax contribution. So $69,000 for 2024, $70,000 for 2025. And then as part of that mega backdoor Roth solo 401k contribution strategy, they'll move those funds from the voluntary after-tax account over to their Roth solo 401k. So now let's go back to the base. Person's age 50 or older, they max out contributions to their day job plan. Again, their goal is just to make Roth and or voluntary after-tax contributions. So really it's the same, right? Because they can't make any employee contributions. They're not interested in making employer pre-tax contributions. They'll just contribute the full amount as a voluntary after-tax contribution. So now let's go back to the base, right? Now we got two participants, right? Back to the husband and wife scenario. So each person's in the same bucket though. Each person maxes out contributions to their day job plan. Each person's not interested in making pre-tax contributions. Each person has $100,000 of self-employment compensation. So again, this scenario illustrates that the contribution amounts don't stay the same. Do stay the same, because what it illustrates is that each person's ability to contribute is based on their scenario, right? That person's income, that person's age, whether that person makes contributions to another plan like a day job plan. All right, so that takes us to the end of the scenarios that we wanted to use to paint the picture. Let's talk about some of the mechanics. So we have an online calculator, which you can find easily on our website. my solo401k.net. Just click on learn. There's a menu that goes left to right. Home, about, solo 401k. Go all the way over to the right. You'll see there's a learn menu. If you pull that drop down, you'll see one of the options is online tools. And that'll take you right to the calculator. So you can enter your self-employment income. You can enter line 14 of your K-1, and then it'll help calculate, or it will calculate 1/2 of the self-employment tax. So it's going to calculate line 14 of K-1. It'll calculate that 1/2 of the self-employment tax. It'll calculate self-employment compensation. It'll also calculate your pre-tax or Roth employee bucket. It'll calculate the employer bucket. Now you got to modify if you make contributions to a day job plan and modify for after-tax contributions. But you can view the report, you can print the report. How do I make contributions? Well, from a solo 401k perspective, it's totally acceptable, of course, to make those contributions by check, in which case you would write annual contribution in the memo section of the check, deposit into the applicable account. Electronic transfer is absolutely acceptable from a solo 401k perspective. Now, the mechanics will depend on where that account is at, right? We're totally neutral on where the accounts are at. We've helped customers open up accounts at hundreds of different banks, many different brokerages. The popular brokerages are Fidelity, Schwab. So Fidelity does allow for electronic deposit from an external account where the name on the external account doesn't match the name on the account at Fidelity, but that's the exception. In other words, the other brokerage firms will want the name on the depositing account, that external account, to match the name on the account at that brokerage. For example, Schwab. So that means that the name of that external account would need to be the name of the plan. Each participant deposits his or her contributions into their own separate sub-accounts. So for example, if you have that husband and wife scenario, there might be 6 different accounts, right? Pre-tax, Roth, and after-tax. And then of course, the different types of contributions, whether it's pre-tax, Roth, and or voluntary after-tax, all likewise need to go into separate sub-accounts. When is the deadline to make contributions? Well, per IRS publication 560, which is the landmark guidance for self-employed retirement plans like solo 401ks, as long as the plan is set up by the end of the year, in other words, someone signs up with us by the end of the year, that'll preserve the ability to make all types of contributions by the business tax return deadline, including any timely filed extension. So for a business tax as a partnership, that's March 15th, or in the case of 2024, March 17th of 2025, or September 15th if the individual files a timely extension for that partnership tax return. Now, there are some additional time under Secure Act, right? Setting up the plan by the end of the year. So for those that signed up by December 31st, or if you already had another plan somewhere else, say a basic plan at Fidelity or Schwab or another discount brokerage that you had previously set up on or before December 31st, 2024, that plan can be upgraded to our plan here in 2025. And now the individual can make all types of contributions for 2024 by their business tax return deadline, including any timely filed extension. So for a business tax as a partnership or an LLC tax as a partnership that's filing Form 1065, that's March 17th of 2025 or September 15th. Now, for those who didn't set up a plan, didn't sign up with us by the end of last year, they could still set up a plan now and make certain types of contributions for 2024. They could still make employer and or voluntary after-tax contributions for 2024, as long as they sign up in time to make those contributions by the partnership tax return deadline. So as long as they sign up by March 7th or March in time to make the contributions by March 17th or September 15th, if they file a timely extension for that partnership tax return. This is a helpful slide as it illustrates how the contribution deadline depends on how the business is taxed, right? Whether it's taxed as a sole prop, partnership, or an S corp. Here are the deadlines for 2025. So obviously there's still plenty of time here in 2025 to sign up and preserve the ability to make all types of contributions for 2025 by the business tax return deadline, including any timely filed extension next year in 2026. So that brings us to how do I report contributions? Well, it depends on the type of contribution that the individual is looking to make, right? If it's a pre-tax employee contribution, that's reported on line 16 of Schedule 1 of the 1040, as well as line 13 of the K-1 using code R. If it's a Roth employee contribution, it's not reportable. Now, if it's a pre-tax or Roth employer contribution, remember that IRS Notice 2024-2 that clarified that even employer contributions that are made as Roth contributions need to be reported as tax deductible for the year for which the contribution is made. So let's say they're being deposited here in 2025 for 2024. Well, that's going to be tax deductible on the employer's return for 2024 for last year, specifically line 16 of Schedule 1 of the 1040, as well as line 13 of your K-1 code R. Now, Roth employer contributions reported as taxable to the employee for the year of the deposit. So if an employer contribution is made as a Roth contribution, it still needs to be taxable, right? Because it's being made on an after-tax basis. So per IRS Notice 2024-2, it'll be taxable to the employee for the year of the deposit. So if it's made for 2024, but deposited in 2025, it'll be taxable as income to the employee via Form 1099-R issued for 2025. How do I convert after tax to Roth? So this goes back to our main topic here, which is mega backdoor Roth solo 401k contributions. Remember, it's a two-step process. You first need to deposit the funds into a voluntary after-tax account before those are moved over to either a Roth solo 401k or a Roth IRA. So from a solo 401k perspective, it's totally acceptable to move those funds by check, by electronic transfer. Of course, the electronic transfer process will depend on the institution where those accounts are set up at. It's even possible to transfer between account types because some individuals have both bank accounts and brokerage accounts. So it's acceptable to go from, say, an after-tax bank account over to a Roth brokerage account for that plan. Now, popular places to open accounts are Fidelity. So if it's going to be at Fidelity, here's an outline of the process, right? Step 1, make the contributions. So open a Fidelity brokerage account for voluntary after-tax funds. Now, Fidelity recently migrated to an online process, towards the end of last year, which is much more streamlined than the legacy paper process. So once that brokerage account is set up for voluntary after-tax funds, make the voluntary after-tax contribution. Step 2, convert to Roth. So either transfer from the voluntary after-tax account to a Roth solo 401k, in other words, an in-plan conversion, or move from the after-tax account to a Roth IRA. Could be a pre-existing Roth IRA that the individual already had at Fidelity or a new Roth IRA. Step 3, report the conversion. So we have an online form that customers use to let us know about those after-tax to Roth transfers. That's how we capture the information we need to prepare the 1099-R that needs to be issued to report that transfer. It's going to be a similar process at Schwab. We would prepare the paperwork as part of the onboarding process because they still run a paper process at Schwab to open the requisite number of accounts, right? It might be 3 accounts at Schwab, pre-tax Roth and after-tax, deposit the funds into the after-tax account, then convert to Roth, either to a Roth solo 401k or Roth IRA. It could be a pre-existing Roth IRA at Schwab. Then let us know about the conversion to give us the information we need to prepare the 1099-R. So we do handle that 1099-R as an optional free service, but since we don't have access to our customers' accounts, they just simply have to let us know about that after-tax to Roth transfer, which they can do 24/7 on our website, mysolo401k.net/forms will redirect to the forms page. You can pick the applicable online form to give us that information. So that'll sometimes lead some folks to ask, well, should I convert those after-tax funds to a Roth IRA or a Roth solo 401k? Well, it depends, right? Depends on individuals' different objectives. So some individuals want to preserve the ability to invest in alternative investments. It's going to be much easier to do that with our solo 401k plan, which allows for investing in alternative investments, whether it's real estate, crypto, private placement, notes, precious metals, etc. That would be a reason to transfer from the after-tax to the Roth solo 401k as an in-plan conversion. Another reason is the ability to take loans. One cannot take a loan from any type of IRA, including a Roth IRA, whereas our plan does allow for 401k participant loans. We prepare the required loan documents as part of our service. So if they think that they might want to use those funds as a 401k participant loan down the future, that would be another reason to keep the funds in a Roth solo 401k. Now, one of the things that has equalized is that now their RMDs, required minimum distributions, no longer apply to Roth solo 401k funds starting in 2024. More on alternative investments would be specific to those individuals that want to invest in real estate. Some of them will want to do that with debt. In other words, combine their solo 401k funds with debt to invest in real estate. Now, whether one does that via an IRA or a solo 401k, it has to be a special kind of debt called non-recourse financing. In other words, there's the only recourse to the lender is the property itself, right? The solo 401k owner cannot guarantee the loan, etc. So the issue, though, is that if one makes that type of debt financed investment via an IRA, the income attributable to that investment that flows back to the IRA will generally be subject to a tax called unrelated debt finance income tax, which will reduce the returns on that investment, where there is an exception to that UDFI tax on debt financed real estate investments in a solo 401k. So for those that are looking to make that type of investment, keeping the funds in a Roth solo 401k is going to present a tremendous advantage. Now, on the other side, some individuals might be satisfied with their Roth IRA, right? It might be giving them the returns that they want, and they just want to simply add more funds to that account. So they might be interested in just transferring the after-tax funds over to a Roth IRA. The ability to withdraw funds from the Roth IRA is also more permissive in the sense that when you want to take money out of a Roth solo 401k, you have to meet a triggering event before you can take those funds out, right? Such as being age 59 and a half or older. Whereas with respect to a Roth IRA, one can take out the contributions, one can take out the conversions without having to meet a triggering event. And one does not have to take out the gains. They can just take out that basis. Whereas if one takes an early distribution from a Roth solo 401k, they got to take a proportionate amount of both the basis as well as the gains. So if it's not a qualified Roth distribution because they haven't had the account for at least 5 years and they're under age 59 and a half, they'll end up having to pay taxes on the gains portion of that early distribution. Now, we talked about how making mega backdoor Roth solo 401k contributions is a two-step process where you first have to deposit the funds into a voluntary after-tax account before they're moved over to either a Roth solo 401k or a Roth IRA. We've talked about how there's a deadline for that first step to make those contributions, right? It's the business tax return deadline, including any timely filed extension. Now, there is no deadline to convert. There's no deadline that by when one must transfer those after-tax funds to a Roth account. Ultimately, that is going to be reportable, and it's going to be reportable for the year of the conversion. So many individuals might be making 2024 voluntary after-tax contributions here in 2025, which of course necessarily means they're not going to transfer the funds to the Roth account until at least 2025. So if they end up transferring those funds in 2025, that will be reportable on a 2025 1099-R, even though the source of the funds was contributions made for 2024. Then they'll get a 1099-R. That'll need to be reported on their 1040. Now, it's not going to be taxable if the only amount that was transferred is the basis, is the contribution. Then you need to move all the money. That's the practice, is to move both all the funds in the after-tax account over to the Roth account. Sometimes there'll be a small amount of gains that accumulated it while the funds were in the after-tax account. So the gains portion will be taxable, the amount of gains that are transferred to that Roth account. So that would be reported separately on that Form 1099-R and then flow to your 1040 accordingly. So these slides are good as it gives us a nice visual of the different accounts. As mentioned, you need separate sub-accounts for the different types of funds. So here we've got a person, one participant solo 401k. They have both pre-tax, Roth, and after-tax for a total of 3 accounts. Here we've got 2 participants. They have 6 accounts, pre-tax, Roth, and after-tax for each participant. Here's a scenario where the person is making those after-tax contributions and then transferring the funds out of the solo 401k to a Roth IRA. So they might just have 2 accounts for their solo 401k, pre-tax and voluntary after-tax, because they're not looking to transfer the after-tax funds to a Roth solo 401k. So as mentioned, we've got some bonus content, which is the fact that our solo 401k plan qualifies for $1,500 in tax credits. As part of the Secure Act, different tax credits were authorized to encourage small businesses to set up 401k plans to help people save for retirement. One of those tax credits is the startup cost credit. Startup cost credit is not available to a solo 401k because the business needs to have non-owner employees, which of course, by definition, a solo 401k is an owner-only plan. So there will not be any non-owner employees participating in the solo 401k. But an owner-only business that sets up a plan with an automatic participation feature is eligible for the auto enrollment credit, which is a $1,500 tax credit. It's $500 per year for 3 consecutive years. It's of course available to new plans or even pre-existing plans that are upgraded to our plan so that they now include the feature. So even if you already have a solo 401k and it gets restated to our plan, now the business will be eligible to claim the credit. And unlike the startup cost credit, where it's based on the actual cost to set up and maintain the plan, the auto enrollment credit, the solo 401k tax credit, is not a function of the cost. Even though the credit is more than our fees, the individual would still be able to claim the full $1,500 in tax credits. So if someone signs up here in 2025, they'd be eligible to claim the credit starting with their 2025 tax return, then again for 2 more years for a total of $1,500, as long as they maintain the plan with that automatic participation feature. Or again, if they already had an existing plan, but then it's upgraded here to our plan in 2025, they'd be able to start claiming the credit when they file their 2025 tax return, then again for 2 more years for a total of $1,500. So it has a tremendous impact on the cost, right? Our fees are $650 is our initial cost. That includes the $500 to $25 establishment fee, plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So the net cost in the first year is going to be $150. In the second and third year, the value of the credit is actually more than our fees. So ultimately, the credits are going to cover our fees for more than 7 years. If you added up all our fees over the first 7 years, it wouldn't amount to $1,500. It's also noteworthy that this is a tax credit, not a tax deduction. With a tax deduction, one reduces their taxable income upon which their tax liability is calculated. Whereas a tax credit, you first determine your tax liability, then the individual is able to reduce their tax liability dollar for dollar. So in that way, tax credit is much more valuable than a tax deduction. What are the eligibility requirements? Well, as mentioned, the individual needs to be eligible to set up a solo 401k, then set up a solo 401k plan with, like our plan, that includes the automatic contribution feature. What is the automatic contribution feature? It sets a default 3% contribution percentage. However, the solo 401k participant, the self-employed individual, as a participant in the plan, has the right to opt out of that default 3% contribution amount. Opting out of the amount doesn't mean that they're not opting out of the default contribution percentage, doesn't mean that they're not eligible to claim the credit. It doesn't mean that they can't contribute. It just now gives them the ability to contribute in whichever amount or schedule they prefer. So it gives them that maximum flexibility, obviously subject to the limits and the deadlines. You're not even required to make annual solo 401k contributions to qualify for the credit. Again, if you have an existing solo 401k plan, could be a basic plan like at a Fidelity or a Census or Schwab, it can be upgraded to our plan. It'll now include the automatic contribution feature. Now the business will be eligible to claim the credits. You claim the credits by filing Form 8881. We have a deep dive webinar that we hosted with an IRS enrolled agent that we can share with you, with all of our customers, right, to make it easy. To give a couple of quick examples, Lindsay's self-employed, has a solo 401k plan. If she amends her plan to add the automatic contribution feature during 2025, so by December 31st, she would be able to claim the credit for 2025, and then again for 2 more years for a total of $1,500, as long as she continues to maintain the solo 401k plan with the automatic contribution feature. Whereas Brad is a solo attorney with no employees, so he's eligible to set up a solo 401k. As long as he signs up with us by the end of the year, he'd be able to start claiming a $500 tax credit when he files his 2025 tax return. Then again for 2 more years, as long as he continues to maintain the plan with the automatic contribution feature. So thank you so much as we went through those slides. Again, if you are on YouTube and you found this helpful, please like, because it helps us to get the word out. Please subscribe and get notifications. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Pacific, then back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. We've got some questions here. We appreciate all the good questions. Thank you so much for bringing the questions. Can I add my spouse as a co-trustee without participating in the solo 401k? Absolutely. There's no requirement for the spouse to work in the business or be an owner of the business to be a co-trustee. Now, if they want to participate, they need to be working in the business and reporting their own earned self-employment income. But having them as a co-trustee, there's no such requirement. Having them as co-trustee now gives them signing authority. Also makes it easier in the event that the solo 401k participant predeceases the spouse and the spouse is the beneficiary. Now the spouse can easily take over the plan, inherit that solo 401k. Perfect. Great question. All right, got a question about Form 8881. I think the credit should come from entering 500 on part line. Let's shoot over that some slides after we're done. Let me make note of your email. Thank you so much for bringing the question. I don't have that information cold, so that's why I don't want to just shoot from the hip here. But let me shoot over the slides. I think that'll answer our question for us. And if it doesn't, let us know. Appreciate your good question. Well, it looks like that second question you chatted over was in that same category. What do you mean by code R? Is that something you need to write into the K-1? Yes, that's something you would work on with your tax advisor, whoever's doing the tax return. You'll see that there's different codes. So that's the code that applies for contributions. Let's pull up that slide again. So those are for the pre-tax employee, pre-tax employer, even Roth employer. We're going to have that same code. Great question. Is the combined total employee and employer contribution limit contribution 70,000? Yes, that's the overall limit for 2025. And then if you're age 50 or older, there's the catch-up contribution, or maybe even the super catch-up if you're age 60 to 63. Of course, you have to have the self-employment income to justify the contribution, right? The total of solo 401k contributions cannot exceed the lesser of self-employment compensation or the overall limit. In other words, one can't save more than they earn. But if you have that self-employment compensation to justify those contributions, yes, it's certainly possible to go up to that $70,000 amount. Well, we do appreciate the good participation. We appreciate the chance to discuss these topics. Please continue to engage. Please like if you find this helpful on YouTube. Please subscribe so you can get the notifications. We'll be back next week to go over these good topics or other topics you might have. So thank you so much, everyone. Till next time.